Okay, so what if I told you that the most painful part of a stock market crash isn't actually the crash itself? I know, it sounds crazy. We see those dramatic headlines, right? The sea of red on TV, and it feels like the financial world is ending. But the real story, the part that truly hurts investors, might be hiding in something we almost never talk about, the recovery. Let's get into it.
Now here's a quote that probably sounds completely upside down. Rational investors are supposed to love when markets go down. Why? Well, because it means all the great companies you'd want to own are suddenly on sale. It's the ultimate chance to buy low.
But if that's true, why does every fiber of our being scream panic when we see our portfolio dropping? That's the real question, isn't it? It's this constant battle between our logical brain and our emotional gut. And today, we're going to unpack that.
So here's the game plan. We'll kick things off with the strange paradox of the fastest crash in history. Then we'll look at a strategy for taming the market. After that, we're going to define what investor pain really is and introduce something called the Kaplan Pain Index to actually measure it. Then we'll dissect the anatomy of a crash and wrap up with what might be your most valuable asset of all.
All right, first up, let's talk about one of the weirdest moments in recent market history. I'm talking about the COVID crash. So cast your mind back to early 2020. The market's humming along at its peak. Then, seemingly out of nowhere, bam, the fastest, most sudden crash we have ever seen. It was terrifying. But then, something absolutely unbelievable happened. By August of that same year, the market wasn't just back. It was hitting brand new all-time highs.
And this is where the paradox really hits you. Think about it. If you just decided to unplug from the news, maybe fell into a coma at the market peak, and woke up 6 months later, you'd check your portfolio and see that you were actually up 20%. You would have completely missed the panic. The rebound was just as historic as the crash itself.
Now, the COVID crash was a V-shaped recovery, a lucky break for anyone who just held on tight. But let's be real, they're not all like that. So what happens when the market doesn't bounce back so fast? Well, that brings us to a super simple but incredibly powerful strategy for taming the beast.
It's called dollar cost averaging, or DCA. And the idea is simple. Instead of trying to be a genius and time the market perfectly, you just don't. You invest a fixed amount of money on a regular schedule, say $100 every single month, no matter what. The real magic here is that it takes your emotions completely out of the driver's seat.
And to see just how powerful this is, let's look at a truly brutal stretch for investors. From the year 2000 all the way to 2012, the market got hit with a nasty 1-2 punch. First, the dot-com bubble burst, and then the 2008 financial crisis. It was basically a lost decade with zero overall growth. Now, check this out. The difference this simple strategy makes is staggering. If you'd invested a lump sum of $14,400 back in 2000, by the end of 2012, you'd have lost money. Your investment would have shrunk to about 11 grand. But if you had just invested that same amount as $100 a month, your portfolio would have actually grown to over $16,000. You would have turned a decade-long loss into a pretty decent gain, just by being consistent.
I mean, that's a nearly 36% difference in your final return. 36%! All just from having a simple, disciplined plan.
But here's the thing. Even with a great strategy like dollar cost averaging, getting through a long downturn is tough. And that's because it's not just a battle for your wallet, it's a battle for your mind. So to win it, we need to understand the real enemy, investor pain. Because this is what's really going on inside your head during a long, grinding bear market. First, you start to doubt your whole strategy. Then, fear and anxiety start whispering in your ear, and emotions take over. Your discipline starts to slip. And honestly, the sheer exhaustion of just waiting for things to get better, it wears you down. So this is where a really fascinating tool comes into play. It's called the Kaplan Pain Index, and it's designed to do something that sounds impossible, to actually put a number on that feeling of financial pain during a crash.
The whole idea is built on one crucial insight, and it's a game changer. It's not just about how deep the crash is, it's about how long it takes to get back to even. The formula looks at both the depth of the fall and the duration of that long climb back. Okay, so let's walk through an example with the 2008 financial crisis. First, the index uses the big one, the 1929 Great Crash, as the ultimate benchmark. It sets that pain score at an even 100. Then, for 2008, it takes the 57% drop and multiplies it by the 5-year recovery. You compare that result to the 1929 benchmark, and you find that the 2008 crisis was about 80% as painful. And when you see it visually, it's just wild.
The 2020 COVID crash, it barely even registers. It scores a tiny 7.1 on the pain index because the recovery was so fast. But the 2008 crisis, with that long, slow recovery, it was more than 10 times as painful.
So what is this index really telling us? Well, it suggests that a lot of what we think we know about the worst market crashes might be completely wrong.
Just look at this table. You see the usual suspects, right? The Great Crash, the dot-com bust, the financial crisis. They're the ones that get all the attention. But what if I told you that, according to this data, the most painful crash of the last century is one that a lot of people barely even remember?
So have a look. Which one do you think it is? The answer might genuinely surprise you.
That's right, the 1970s oil crisis. It scored a massive 108.6 on the index, meaning it was even more painful than the Great Crash of 1929. The market fell almost 50%, but it took a grueling, soul-crushing 8 years to get back to where it started.
And this is the single most important takeaway from all of this. The data makes it crystal clear. It's not the sudden shock of the crash that truly breaks investors. It's the long, slow, agonizing crawl back to break even. That's where discipline dies and bad decisions are born. Okay, so this brings us to the final and most critical point. Now that we understand what really causes market pain, we can focus on the one thing that helps us survive it. The legendary investor Charlie Munger absolutely nailed it. The big money is not in the buying and selling, but in the waiting. The real key to building wealth isn't being a hyperactive trader. It's having the patience to just wait.
At the end of the day, the market is going to do what the market is going to do. You can't control it. The real risk, the only thing you actually can control, is how you react. And a disciplined strategy like dollar-cost averaging is designed for exactly that, to be a shield that protects you from your own worst emotional instincts during that long, painful crawlback.
So we'll leave you with this final thought. Another market crash isn't a matter of if, it's a matter of when. We know for a fact it will happen again. So the only question that truly matters is, knowing what you know now, how are you going to react?